Hey guys, welcome back to the channel, and we have actually finished up today. We were down big in pre-market. I was thinking this could be the day we have the 2 or 3% sell-off like we've been looking for. We haven't had one all year, but no, we actually held on and we actually finished the day higher. The NASDAQ actually bounced off its high from December today and held, so there was some bullish price action out there today. Make sure you stay to the end. I'll give you how I'm personally positioned going into next week. We got the CPI report coming up on Tuesday, which should be a real big one, and then we've got options expiry on Friday. So looking over markets today, it was a bit mixed. There was definitely a rotation out of the growth and high beta cyclical names into defensive. Actually had China off 2.8% today. Volatility rallied in the morning, but then just retraced all in the afternoon. We almost touched 22, but still finished the day above 20 here. Volatility of volatility is still high, sitting up on the top of its line here. What was different today was the put-call ratio. Finally had some people buying some hedges, so they might be worried about CPI inflation being higher than possibly expected, and I think also a combination of the meme stock buyers buying less calls. So saw the put call ratio shoot up to 105 today. But the big thing today was look at all the growth cyclical sectors versus defensive sectors. They rolled over today and broke through the trend lines that we have been watching, and we hinted at this yesterday in our video that we looked at the growth versus value ETF yesterday, and we saw that just sneak down through our trend line, and sure enough it's gapped down pretty big today. We also had high yield versus the 3-7-year treasury. So looking at similar durations, that has gapped down. And if we just zoom out to a monthly chart on this spread, we can see it's forming like a bearish triangle. And last time we've had these formations has led to downward movement. So this chart looks bearish to me, and that's bearish for risk equity sentiment. But again, the theme today, we had rates higher. 2-year shooting up and sitting up the top of its range there. Same with the 10-year shooting up. And look at Fed fund futures. We've got June at 511, September at 516, September at 497. December and September have actually closed at their all-time highs. We did tick a little bit higher back here in November, but it closed lower. So this is super bullish price action on rates, and this looks to me like the bond market could possibly be pricing in a higher than expected CPI report on Tuesday morning. So consensus estimates is we're coming in at 6.2% year-over-year growth. If that would tick up a bit higher, we would see these rates shoot up, and that would be really bad for the stock market. If you look at other periods of when we've had a higher inflation and it rolls over, it doesn't just go down in a linear fashion. It will bounce and pull back. So we could be seeing a higher CPI report come out on Tuesday, and that's certainly what the price action of the Fed funds futures look like. I mean, the market was trying to call the bluff on Jay Powell and almost kind of egg him on to pivot and get dovish. And the market was saying something that the Fed was actually going to decrease rates by the end of the year. But now the market looks like to have repriced swiftly and pulled itself in line with Jay Powell and the Fed's trajectory of interest rates. And maybe the market might even start getting ahead of the Fed, because we've already got September Fed funds at 517. And this looks like to be breaking out after we've been consolidating for the last couple of months. So things could get really interesting here. We're at a pretty critical level here with Fed fund futures pricing and rates. And with that rates high, we've had treasuries come off, and look at high yield. High yields gapped down and held on above average volume below its 50-bar VWAP. So that's bearish for risk sentiment. And with that higher rates, we've had the dollar hold. And the dollar's holding pretty good. You can see yesterday we had a hammer formation, and now it looks to be consolidating and holding above its 50-bar VWAP. Bitcoin came off a little bit. What was commodities didn't. You would think with a higher dollar and rates, commodities would have came off, but commodities have actually held strong, except for Dr. Copper. He was gapped down here, and he looks to be holding under his 50-bar. Gold was flat. News came out, Russia's cutting oil production, so that sent oil up quite a bit today. And natural gas, if you've been watching the channel, you know we're playing this long here, looking for a bounce. We did tighten our stop and target today. We had a bit more looser than this, but we've pulled down our stop to 756 and our target is 1014, which is about around the 50 bar VWAP, and that's still given us a 2 risk to reward ratio from our entry at 841. So make sure you say subscribe to the channel and we'll keep you updated on how this trade plays out. But we're thinking this is the bottom with all this volume and we're bound to get a little bounce up. I wouldn't be surprised if we get a bounce up to 1213, but we're just looking for a 2 risk to reward ratio on this trade. We had uranium pop up a little bit today. And over to all the stock sectors, if we just go through a quick scroll through, we can see we had, with oil up, obviously energy and oil and gas exploration and production up pretty good. We had the growth cyclical sectors off today, so clean energy, tech, discretionary. Semis came off, with NVDA come off. I'll get to that in a bit. And here's the rotation into healthcare up, staples up, and utilities. Utilities actually up pretty good today on volume. But healthcare, not really up on volume, nor staples, and they're kind of still trending down under their 50 bar. So you couldn't really say this is a big turning point here. We did have the defensive sector. You look at this on a monthly chart, the defensive sector compared to the market, it's nearing all-time highs. It looks like it's going to break out. And with all the geopolitical tension backdrop with China and Russia, I think there's a tailwind coming into the sector. The government's going to keep spending on these companies. And it's a good hedge to have if things do spill over with Taiwan and Russia into Europe. So we like that. We've actually got this ETF in our long portfolio. Okay, so moving on to stocks. BlackRock Barometer was up a little bit today. Mega Cap Tech was a bit softer across the board. Meta's actually fell 2%, and looks like it might want to come and fill its earnings gap back down to 153. NVIDIA was off hard today. So if you watch the channel, I've been saying the price action semis is so strong. I didn't want to short it up here. Congrats if you did, because you caught a great move today. Gap down, we've broken this trend line. It was on volume as well. So this may come down and test this previous resistance here. This might turn into support, I suspect. So this could still have a little bit further to go to pull back, because we've just done so well. We're even still today 21% above the 50 bar. So that was interesting with semis rolling over today. Netflix was down hard too, 4%, as was Barber and Tesla. So it's to be expected. We've had such a great run up since the bottom here at the start of the year. We haven't had a decent pullback, and it looks like we may have just put one in with this little spinning doji island. That's a bearish reversal formation. If we can take out the low from today, next week, that'll probably confirm it, and I wouldn't be surprised to see us come back down and test 183 or 155. If we did get a 50% retracement on Tesla, that would take us back down to around that 155, 158 level. So even if we continue on to a bull trend, if Tesla breaks out into a new trend, it wouldn't be all that out of the ordinary to see it have a 50% pullback here and test its 50 bar VWAP, which we're still 28% above as well. So however, I still wouldn't short it here. It's still got so much bullish momentum, and Tesla's just one of those stocks you wake up in the morning and it's gapped 5% against you. So I wouldn't short it here. I wouldn't buy it here, but it could be setting up for a pullback in the next week or two. Over to meme stocks, they were largely down across the board. Carvana, Bed Bath & Beyond down 9%, AMC down 8%. So it definitely looks like we've turned on this whole risk on, growth cyclical meme thing, and we can see that with the put call ratio up today as well. Over to active stocks, XPD report came in worse than expected. The stock sold off 8% really hard. Cloudflare did all right though, up 3%. Coinbase, I think the SEC just fined their big competitor Kraken, so the market's not liking that. So there's been a full-on reversal here. Lyft, ouch. Sorry if you held this one. down 36%. Numbers came in way worse than expected. Market was expecting EPS 12 cents per share, came in negative 76. So Uber's clearly the winner in ride transport, and I just can't get my head around these things long term. I mean, if you think about it, we've never seen a taxi company come public to the market, and it's kind of like you can't value it like a tech stock. It's kind of like a utility, and so I don't think it deserves like a tech premium multiple, and is losing money as well. So I just find it hard to get my head around investing in it, even in Uber. I mean, I know Uber's got a great brand long term, but it struggles with profitability, and at the end of the day, it's a taxi company. PayPal did pretty good on volume, is held here, and that's about it on the stocks today. Okay, so what do we think on SPY and how I'm positioned going into next week? So this morning I was looking at it pre-market. We were down, I think, almost 1% on NASDAQ. I think, well, this is the day, going into the weekend. Normally we can see a big move coming in on Friday. Had every reason to risk off, coming into CPI and this rotation trade coming off, but it didn't. The market held, and you can see we've bounced off this previous resistance here, and this could be holding. So that was bullish price action, and as always, prices lead, fundamentals follow. So I can't deny that. Even though they've got a lot of contrary indicators, volatility is holding above 20. I can see breadth on the amount of stocks above their 20-day average did roll over, and definitely the growth cyclical thing has rolled over. The biggest thing for me and why I can't get bullish is rates. I mean, the market, this is just really bullish price action with Fed fund futures, and I just got a feeling CPI could come in worse than expected. It's expected to be 6.2% year-over-year growth. If that comes in 6.3, 6.4, 6.5, stock market's going to sell off hard, and the rates are going to go up, and I think there's going to be a big repricing out there and risk equity sentiment. We've had such a good run up so far this year in stocks, and the bond market is just telling me, don't get long stocks. So I just can't be long stocks in the face of this price action of rates. We've just closed at the highest level ever in September and December, Fed fund futures. So the market could actually start pricing in higher rates than what the Fed's anticipating. When it was only just a week and a half ago, it was saying, no, you've got to cut. This has been a big swift change, and that can normally kick things off and continue even more. We've got options expiry next Friday as well. So with CPI and OPEX, next week could get a bit spicy. However, with this price action holding on here, the market just had every reason to sell off, but it didn't. And I know there's a big down day around the corner, because normally we get one every month. We don't get one that month. We normally almost all the time get it the next month, and we haven't had one all year, and we're coming up halfway through February. So I know there's a big red candle in there somewhere. And if you're watching the channel and you knew I came in today 100% net short, and it was looking good this morning, but I actually ended the day down a little bit, and I trimmed back my net short exposure to 40% net short. And that's how I'm going into next week. Normally going into CPI, I don't carry big. I'm not heavily tilted one way or another, because it's often a binary event. I don't want to be on the wrong side of a 2-3% move. So I was always going to get back down closer to flat. I would have loved if the market came off 2-3% today to flatten out a bit, but so be it. That's trading. I'll keep my 40% net short. I'll probably take it down to 20% net short on Monday, depending on price action, but I doubt I'll go above 40% net short going into CPI. And if CPI comes in above than expected, watch out below. But that pretty much sums it up for today. Thanks for tuning in. Again, I appreciate your support. I hope you have a great weekend, and I hope to see you on Monday afternoon to talk about price action going into CPI. Take care.